Every few decades, the market delivers a moment that tests not your portfolio, but your psychology. 2026 will be one of those moments. The headlines will scream collapse, charts will look catastrophic, and the crowd will be paralyzed by the illusion of loss. But if you understand how markets really work, and more importantly, how you work under pressure, you will recognize that the crash isn't the end. It's the beginning of the next great transfer of wealth. Every crash is nothing more than the market recalibrating belief systems. Investors who built their confidence on rising prices will lose it the moment those prices fall. Traders who mistake volatility for danger will retreat when they should advance. And those who have trained their minds to stay objective, calm, and opportunistic, those are the ones who walk away richer when the dust settles. The market doesn't punish people for being wrong. It punishes them for refusing to accept they could be wrong. And in a crash, that refusal costs everything. The average investor will wait for certainty. They'll look for a sign that things have stabilized before acting. But by the time certainty arrives, the professionals have already bought the fear, positioned for recovery, and moved ahead. The amateurs will once again buy high, right before the next storm. You must understand this truth. The market doesn't move because of news, interest rates, or politics. It moves because of emotion, and emotion is predictable. Fear spreads faster than facts. Greed blinds faster than loss. The 2026 crash will not be about charts or earnings. It will be about collective panic. The majority will sell not because they have to, but because they can't handle the discomfort of uncertainty. That's where you gain your edge. You don't need to predict the bottom. You need to prepare your mindset to act when everyone else freezes. The opportunity doesn't appear when the market stabilizes. It appears when it feels unbearable to act. The discomfort you feel in those moments is the emotional cost of entering at a discount. The reason most people fail in market crashes isn't lack of information. It's lack of psychological conditioning. You can have all the data, all the charts, all the signals. But if you can execute calmly when the world is losing its mind, none of it matters. Mastery in trading comes from internal control, not external conditions. So, what should you do now? You build mental liquidity. That means staying emotionally flexible, financially prepared, and strategically patient. The crash will reward those who can detach from the noise, see the bigger structure, and trust their process when nothing else feels certain. You don't need to know when it happens. You just need to know how to respond when it does. Markets are designed to exploit emotional weakness. They amplify fear so that assets can transfer from the unprepared to the prepared. That's not manipulation. It's the natural order of trading psychology. The strong hands absorb from the weak, not because they're smarter, but because they're calmer. Every panic is an auction of emotions, and the lowest bidder wins. Think back to every major crash in history, 2008, 2000, 1987, even 1929. The storyline never changes. Panic first, recovery second, regret third. The crowd sells out of fear, the few buy out of discipline, and when the cycle reverses, the roles switch. The ones who panic now chase. The ones who prepared now relax. You can't control the market, but you can control which side of that equation you're on. The crash of 2026 will be brutal only for those who treat it as punishment. For those who treat it as a test, it will be the defining moment of their financial future. The pain others feel will be the fuel for your growth. If you stay centered, remember, chaos doesn't destroy value. It redistributes it. Right now, you should be training your focus, not your fear. Build your watch list. Strengthen your liquidity. Create clear rules for how you'll enter and exit positions. Know your risk per trade and your emotional tolerance per loss. The time to think is now, because when the crash comes, thinking will be replaced by instinct, and only disciplined instinct makes money in panic. You don't prepare for a storm by praying it doesn't happen. You prepare by building stronger foundations. That's what psychological discipline is. It's emotional architecture built before the chaos arrives. When volatility spikes, it's not the market's behavior you should manage. It's your own. Your reactions are your results. Ask yourself, what would happen if you stopped reacting to fear and started responding to opportunity? What would happen if you looked at red charts not as warnings but as discounts? What if the next crash wasn't a signal to run but an invitation to rise? That's how professionals think. They don't need certainty. They thrive in uncertainty. They understand that markets cycle through expansion and contraction, euphoria and despair. The amateurs treat each phase as permanent. The professionals treat it as temporary. When others see collapse, they see compression before the next breakout. This is the mindset you need before 2026. Don't look for predictions. Look for preparation. Don't wait for reassurance. Build resilience. Don't fight the market. Flow with it. Because when the fear hits its peak, when the headlines predict the end, when everyone else is paralyzed, that's when your calm will be worth more than cash. Opportunity is never gone. It just hides behind emotion. The crash will expose who's been driven by reaction and who's guided by awareness. Your goal isn't to avoid fear, it's to use it as data. It tells you where the crowd is leaning, where the imbalance is forming, where the future value is being created. This isn't about timing a market. It's about timing yourself. The crash will pass, but your ability to stay composed, objective, and consistent will compound for decades. This isn't the time to fear losing money. It's the time to stop losing control. When 2026 arrives, you'll see two groups emerge. Those who are emotionally broke and those who are psychologically rich. The market won't decide which one you become. Your mindset will so do this now. Build awareness, not anxiety. Strengthen discipline, not prediction. Train calmness, not confidence. Because the moment you can remain peaceful in panic, detached in drama, and focused amid fear, you've already won. Every time the market trembles, every time a red candle stretches across the screen, every time a headline screams collapse, a fascinating transfer begins. Not of stocks, not of assets, but of belief. Fear moves money faster than any algorithm. It is the invisible hand behind every emotional decision, every panic sell, every missed opportunity. The irony is that fear feels like protection, but in markets, it's the most profitable illusion ever created. It convinces the majority to run, just as the minority steps in to collect what's left behind. To understand this illusion, you first have to understand what fear really is. Fear is not about what's happening. It's about what you believe might happen. It's your mind projecting danger onto uncertainty. The market is built entirely on uncertainty. Prices fluctuate, trends reverse, news changes, narratives evolve. That uncertainty triggers the mind's most primal instinct. Self-preservation. The moment your money feels threatened, your brain interprets it as survival, and the moment you operate from survival, you stop operating from strategy. That's when professionals, those who have mastered emotional control, take over. Every major crash, correction, or pullback follows the same pattern. A wave of fear floods the market, and rationality disappears. In 2008, investors sold assets at the very bottom, convinced the world was ending. In 2020, during the pandemic panic, billions were withdrawn from the market, right before one of the fastest recoveries in history. The illusion repeats because fear never leaves, it just changes form. It whispers new stories, wears new faces, and dresses itself in whatever narrative will make you react first and think later. The market doesn't reward courage, it rewards clarity. But clarity can only exist in the absence of fear. When everyone is afraid, clarity becomes rare, and rarity creates value. Think about that. Fear creates opportunity, not destruction. It's the emotional fog that blinds the majority and gives vision to the few who can stay calm. Professionals don't see fear as a signal to run. They see it as an indicator of mispricing. When emotion distorts perception, prices detach from value. That's the moment wealth quietly shifts hands. The reason fear is so profitable is that it's predictable. You can't predict the market, but you can predict how people will feel about the market. When prices fall, people panic. When prices rise, they get greedy. The sequence never changes, only the magnitude does. Professionals understand this. They don't trade the market, they trade the crowd's emotions. When fear peaks, liquidity dries up, prices overshoot to the downside, and opportunities emerge. Fear pushes assets to discounts that logic could never justify. Those who remain patient during that storm reap the rewards. Once emotion fades and reality returns, most investors believe they're logical. They think they're reacting to information. But information doesn't create fear. Interpretation does. 10 people can read the same headline. 9 will panic, 1 will prepare. What separates them is not knowledge, but perspective. The fearful investor interprets bad news as danger. The disciplined one interprets it as data. The same event that paralyzes the majority activates the opportunity-seeking instinct in the minority. That difference in perception, magnified over time, is what builds fortunes. Here's what fear does. It makes temporary situations feel permanent. It convinces you that every downturn is different, that this time the system won't recover. It makes you forget history, patterns, and probability. Fear hijacks logic and replaces it with urgency. The mind tells you, act now before it's too late. But in the market, the truth is the opposite. Acting impulsively is what makes it too late. The illusion of safety that comes from selling out during panic is short-lived. Once the market rebounds, and it always does, the same fear that made you sell becomes regret that keeps you from re-entering. Professionals know this cycle intimately. They don't escape fear, they simply understand it. They expect it. They even welcome it, because fear is the emotional fuel of volatility, and volatility is what creates outsized returns. If the market moved in straight lines, nobody would make money. It's the extremes, the fear-driven sell-offs and euphoric rallies, that generate the price distortions necessary for profit. Fear creates liquidity for those ready to buy. It shakes weak hands out of strong assets. It redistributes wealth from those who react emotionally to those who act strategically. But make no mistake, managing fear isn't about pretending to be fearless. It's about building awareness so strong that fear loses its control over you. When you acknowledge fear without obeying it, you step into a position of power. You can see what others can't because you're no longer blinded by emotional fog. You start to see patterns instead of panic, opportunity instead of threat. You realize that what most people call risk is actually reward, disguised by discomfort. The illusion of fear works because it feels so real. You can feel it in your stomach when your trades go red, when your portfolio drops, when the media floods the screen with crisis talk. Every instinct tells you to run. But the market isn't a predator hunting you, it's a mirror reflecting your mindset. If you project panic, it will give you panic. If you project patience, it will give you perspective. The challenge isn't in timing the market. It's in mastering the internal dialogue that interprets it. The truth is, fear doesn't destroy capital. Mismanagement of fear does. The same fear that makes one investor sell everything makes another double down on opportunity. The difference lies in conditioning. The professional has rehearsed those emotions thousands of times. They've felt the pain of drawdowns, the uncertainty of losses, the frustration of volatility. But they've trained themselves to detach. They see fear as a tool, not a threat. Like a sailor who's faced countless storms, they've learned that fear isn't a signal to abandon ship. It's a reminder to adjust the sails. Think about the biggest opportunities in financial history. Every single one was wrapped in fear. In 2008, when Lehman collapsed and headlines screamed Great Depression 2.0, those who stayed rational and bought quality assets made generational wealth. In 2020, while fear of a global collapse reached extremes, markets rebounded to new highs within months. The people who acted without fear weren't lucky, they were prepared. They understood that fear always exaggerates reality. It takes uncertainty and inflates it into catastrophe. Once you learn to see through that exaggeration, you gain the ultimate trading edge. Objectivity. Objectivity is the antidote to fear. It doesn't mean you ignore risk. It means you measure it accurately. The fearful trader sees a falling price and imagines disaster. The objective trader sees the same fall and measures potential reward versus risk. The fearful trader asks, what if I lose more? The objective trader asks, what if this is the opportunity everyone else is too afraid to see? That shift in questioning changes everything. It transforms emotion into awareness, and awareness into profit. You see, the illusion of fear thrives on immediacy. It wants you to believe that the present moment defines everything. But markets reward those who think in probabilities, not absolutes. Fear says, it's all over. Probabilistic thinking says, this too shall pass. Fear demands reaction. Probability demands patience. That's why traders who understand psychology outperform those who rely purely on information. They've built emotional distance between stimulus and response. When the crowd screams, they listen quietly. When the crowd runs, they walk forward. Every losing trader shares one common trait. They treat fear as truth instead of perception. The market drops and they assume that means they are in danger. But danger isn't in the market. It's in the belief system you bring to it. Fear preys on attachment to money, to being right, to avoiding discomfort. Once you detach from those attachments, fear loses its power. You stop seeing loss as a threat and start seeing it as data. You stop fighting uncertainty and start flowing with it. Fear's profitability comes from its universality. Everyone feels it, but few understand it. The professionals who do understand it use it as a compass. When fear spikes, they know the crowd is capitulating. When optimism returns, they know the crowd is getting complacent. Fear and greed create the rhythm of markets, and those who can step outside that rhythm, who can observe it instead of dance to it, become the ones writing the music instead of following it. The greatest illusion of all is that fear protects you. It doesn't. It protects your ego, not your capital. It gives you temporary emotional relief at the cost of long-term opportunity. Selling during fear feels good in the moment, but it cements loss and blocks recovery. The illusion works because it satisfies your need for control. When things feel uncertain, fear gives you something to do. Even if that action destroys your results, mastery comes when you learn to sit through that discomfort without reacting to it. When the 2026 crash arrives, and it will, fear will again become the dominant currency. Prices will fall faster than logic can process. Narratives will turn dark. Analysts will compete to outdo each other with doomsday predictions. But behind that noise, behind the headlines, a quiet minority will be accumulating. They'll be buying not because they're reckless, but because they understand the illusion. They know that fear magnifies short-term pain but conceals long-term value. They know that the market doesn't punish fear. It rewards those who can move through it. You can't eliminate fear from trading. You can only neutralize its influence. The way to do that is through structure, have predefined risk, clear entry criteria, and rules for exiting both winners and losers. The moment you have a system that removes the need for emotional decision-making, fear becomes just another piece of information, not a dictator of behavior. Structure breeds confidence, and confidence dissolves fear's illusion. The next time you feel fear in the market, pause. Don't fight it, don't deny it, observe it. Ask yourself, what story is this emotion trying to tell me? Is it a story of protection or a story of limitation? Is it showing you something real? Or is it just an echo of uncertainty amplified by the crowd? Once you begin to see fear as data, it loses its grip. It becomes a signal, not a sentence. Fear is the market's most profitable illusion because it keeps the majority predictable. It makes people sell what they should hold and hold what they should sell. It ensures that emotions, not logic, drive the flow of money. And as long as fear exists, opportunities will too. The goal isn't to destroy fear. It's to rise above it. Because when you can stand in the middle of chaos, calm and clear, while everyone else sees disaster, you're not just surviving. You're profiting from the greatest illusion ever created. Every outcome in trading, investing, or wealth building begins long before any button is pressed, chart is analyzed, or trade is executed. It begins in the mind. Every market move, every profit, every loss, these are not merely reflections of external events, but of internal conditions. The illusion most people live under is that success comes from predicting the market, timing the perfect entry, or mastering some technical formula. But that's not the truth. The truth is simpler and more profound. Control the mind and you control the outcome. The mind is the first and last frontier of financial success. It dictates what you see, how you feel, and what you do in every market situation. You can't control the market, but you can control the way you interpret it. That's the difference between consistent winners and everyone else. They operate not from reaction, but from awareness. They understand that their internal state determines their external results. The undisciplined mind sees chaos and fear. The trained mind sees structure and opportunity. Think about how most people behave under pressure. When prices fall, they panic. When prices rise, they chase. When uncertainty increases, they freeze. Every one of these reactions begins not with the chart, but with an internal dialogue. The mind whispers, what if I lose? What if I miss out? What if this time is different? Those whispers become beliefs, those beliefs become actions, and those actions create results. The entire cycle is psychological. The market is just the stage where your mental habits perform. The paradox is that most traders spend years learning strategies, but almost no time learning self-control. They master analysis, but ignore awareness. They believe success is about knowing what to do, not realizing that the real battle is in doing what they already know. Every trader knows they should cut losses, let winners run, and stay patient. Yet few can actually do it. Why? Because knowing is cognitive, but control is emotional. Until you train the emotional brain, the intellectual brain will always be a hostage. When you understand that your mind is the operating system of your financial results, you start to approach the market differently. You stop trying to force outcomes and start focusing on your responses. You realize that external events don't determine your fate, your interpretation of them does. The market isn't against you. It doesn't know you exist. It's neutral. What makes it seem hostile is your attachment to expectations. You don't lose money because of volatility. You lose because you can't emotionally handle volatility. You don't blow up because of the market. You blow up because you fought your own fear. Control begins with awareness. You can't master what you won't observe. Every reaction, anger, greed, hesitation, overconfidence comes from an unconscious pattern. Until you see it clearly, you'll repeat it endlessly. The mind has a way of disguising these patterns as logic. You'll convince yourself you're adjusting strategy, when in truth you're reacting emotionally. You'll tell yourself you're cutting risk, when in truth you're cutting out of fear. The ego doesn't want to be wrong, so it rationalizes every behavior to maintain the illusion of control. True control starts when you stop rationalizing and start recognizing. The most successful traders and investors aren't superhuman. They've just reconditioned their minds. They've learned to respond to uncertainty with calm instead of panic. They've built habits that align with probability, not emotion. When they feel fear, they don't suppress it. They study it. They know that every strong emotion points to a belief that's either outdated or unhelpful. The work, then, isn't about eliminating emotion. It's about understanding it. Fear, greed, hope, all are data. They're feedback from your subconscious telling you where your beliefs conflict with market reality. To control the mind is to detach from the need for certainty. The market's greatest weapon is unpredictability. It thrives on confusing the majority. But if you can learn to exist comfortably within uncertainty, you disarm that weapon. Most people fail because they seek emotional comfort in an environment designed to produce discomfort. They want predictability in a system that's inherently random. That mismatch causes stress, and stress triggers impulsive behavior. Once you accept uncertainty as the natural state of markets, fear loses its power. You stop demanding that the market behave your way, and you start aligning yourself with how it actually behaves. Control doesn't mean suppression. It doesn't mean becoming emotionless. It means awareness without attachment. It means you can experience an emotion fully without acting on it blindly. When your trade moves against you, you can feel disappointment without turning it into despair. When your trade moves in your favor, you can feel excitement without turning it into recklessness. That's emotional balance, the foundation of consistency. Without it, you'll always oscillate between euphoria and fear, confidence and hesitation, gain and loss. The illusion most traders fall for is that control means controlling outcomes. You can't control price, news, or market reactions. But you can control your preparation, your process, and your perspective. That's where true power lies. When you let go of the illusion of external control, you gain internal mastery, and ironically, that's when your external results begin to improve. The less you try to force outcomes, the more consistent your outcomes become, because your behavior stops being reactive and starts being aligned with your plan. The mind must become a mirror, not a sponge. Most people absorb market noise, the opinions, the fear, the hype, and then react to it as if it were their own thought. They read headlines and feel emotions that don't even belong to them. Controlling the mind means filtering out external influence and thinking independently. It means having a clear framework for interpreting events. When you stop absorbing everyone else's emotions, you start seeing the market as it is, not as the crowd imagines it to be. Every trade you take reflects your state of mind at that moment. The undisciplined mind looks for excitement. The calm mind looks for opportunity. The fearful mind looks for escape. And the confident mind looks for execution. That's why two traders can look at the same chart and take opposite actions, because what they're really trading isn't the chart. It's their belief about it. The mind creates meaning, and meaning creates behavior. Change the meaning, and the outcome changes automatically. There's an ancient principle that applies perfectly to trading. As within, so without. Your external world mirrors your internal one. Chaos inside produces chaos outside. Clarity inside produces clarity outside. Every time you lose emotional control in the market, it's not because of the chart. It's because of unresolved internal tension. You might think it's about money, but it's not. Money is just the medium through which your mind expresses fear, greed, and attachment. The market simply reflects those emotions back at you with dollar signs attached. Controlling the mind also means managing self-talk. The dialogue in your head determines your decisions. When you think, I can't afford another loss, you trade from fear. When you think, I must be right, you trade from ego. When you think, let's see what the market is showing me, you trade from awareness. The language you use internally shapes your emotional state. Change the language and you change the outcome. Replace self-criticism with observation. Replace judgment with curiosity. Replace panic with patience. Over time, that mental reprogramming rewires your responses. The market is the ultimate psychological feedback loop. Every decision you make shows you where you stand in your relationship with uncertainty, risk, and discipline. If you can learn to interpret that feedback instead of resisting it, your growth becomes exponential. Every loss becomes a lesson in emotional control. Every win becomes a lesson in humility. Every mistake becomes a map pointing towards self-awareness. The traders who grow the fastest are the ones who use the market as a mirror, not a battlefield. Control the mind and you gain freedom from outcomes. That's not the same as not caring. It means your emotional state is no longer dependent on immediate results. Whether you win or lose, your mind stays centered. You stop judging trades as good or bad and start judging them as aligned or misaligned with your process. That shift is monumental. It removes the emotional roller coaster that destroys consistency. It allows you to act from logic in a world that thrives on emotion. To control the mind is also to master patience. The undisciplined mind seeks constant stimulation. It wants to trade, to act, to do something. But mastery lies in restraint. It's the ability to wait for the high probability setup, the right alignment of conditions. It's knowing that doing nothing is often the most powerful move you can make. The mind that can't sit still in silence will never perform well in volatility. Stillness is not weakness. It's strength disguised as calm. The controlled mind operates from a state of flow, not force. It doesn't fight the market. It adapts to it. It doesn't chase. It responds. It doesn't need to predict. It simply prepares. This flow state arises when action and awareness merge, when there's no friction between what you know and what you do. In that state, you don't overthink. You simply execute. You're fully present, fully aware, and fully detached from the outcome. That's where peak performance lives, in total engagement without emotional distortion. But reaching that level requires practice. You can't meditate your way into control if you won't confront your patterns. You can't affirm your way into success if you don't dismantle your self-sabotage. Control comes from observation and repetition. It's built trade by trade, mistake by mistake. Every time you choose awareness over reaction, you strengthen mental muscle. Every time you respond with discipline instead of emotion, you reinforce the neural pathway of control. Over time, the mind that once ruled you becomes your greatest ally. Remember, the market is not personal. It doesn't care who you are or what you want. It will always test your emotional boundaries, expose your weaknesses, and amplify your illusions. You can't stop it from doing that, but you can stop identifying with every emotional wave it triggers. That's what control means. It means being the observer, not the participant, in your emotional drama. It means staying steady in a world that thrives on instability. When you control the mind, outcomes stop being random. They become reflections of disciplined behavior repeated consistently over time. You begin to see that success isn't about predicting the next move. It's about becoming the kind of person who doesn't break when it happens. The crash of 2026, or any market event, won't make or break you. Your reaction to it will. The uncontrolled mind will panic and sell. The controlled mind will breathe and prepare. Same market, opposite results. So control your mind, not by suppressing emotion, but by mastering perception. Let go of the illusion of control over the market and claim the only control that truly matters, over your thoughts, your reactions, and your beliefs. When you do, every chaotic move becomes data, every setback becomes preparation, and every outcome becomes progress. Because in the end, your portfolio doesn't mirror the market, it mirrors your mind. Control the mind, and you'll discover that success was never about the market's behavior. It was always about your own. Every trader wants to know what happens next. Every investor wants the crystal ball, the secret forecast, the whisper of certainty in an ocean of chaos. But the truth, the uncomfortable, liberating truth, is that prediction doesn't create success. Adaptation does. Markets don't reward those who can predict the future. They reward those who can respond to the present. The ability to adjust, evolve, and stay psychologically flexible is what separates the survivors from the casualties when the market turns violent. Prediction is an illusion of control. It gives you the comforting sense that you understand what's coming, but that comfort is deceptive. The market doesn't care about your forecasts. It doesn't owe you consistency. It will humble every assumption and punish every rigid belief. The moment you think you know what's next, you stop listening, stop observing, stop learning, and that's when the market takes everything back. Survival doesn't belong to the smartest, the fastest, or even the most informed. It belongs to those who can adapt without emotional resistance. Adaptation is the opposite of prediction. Prediction seeks to control the future. Adaptation seeks to harmonize with it. The market is a living, breathing organism, constantly changing, unpredictable, influenced by billions of decisions made every second. Trying to predict it is like trying to tell the wind where to blow. But if you learn to adjust your sails, to read the pressure of the wind instead of fighting it, You'll move forward regardless of the direction. That's the essence of survival in trading. Not knowing where the market will go, but knowing that whatever it does, you can adjust. Every market cycle exposes two types of participants, the rigid and the responsive. The rigid cling to their forecast. They say it has to go up, or it can't go lower. They anchor themselves to narratives, opinions, and ego. When the market moves against them, they freeze. Their attachment blinds them. Their need to be right outweighs their ability to see clearly. The responsive, on the other hand, flow with change. They don't predict. They prepare. They observe objectively, act decisively, and detach emotionally. They understand that the goal isn't to be right, it's to stay in the game. The human mind craves certainty. We feel safe when we think we know what's coming, but markets are designed to exploit that craving. They lure you in with patterns that look predictable, then reverse violently. They build belief, then break it. Every crash, every reversal, every false breakout exists because the crowd's need to predict blinds it to possibility. Adaptation begins where certainty ends. It begins when you accept that your job is not to know, it's to respond. Think of nature. The species that survive aren't the strongest or the smartest, they're the most adaptable. The same is true in markets. The investor who insists on being right will eventually go extinct. The one who adjusts will endure every cycle. When volatility rises, the adaptive trader tightens risk. When conditions change, they shift strategy. When opportunity fades, they step aside. They don't resist reality. They evolve with it. The more flexible your mind, the more durable your capital. Prediction is rooted in ego. It's a need to prove something to yourself, to the market, to others. You predict because it makes you feel powerful. But markets don't care about your identity. They care about liquidity. They exist to transfer wealth from those who need to be right to those who can adapt. Every time you attach your self-worth to a forecast, you trap yourself in emotional rigidity. You stop seeing what is because you're too attached to what you want to be. Adaptation, on the other hand, is rooted in humility. It's the recognition that the market is always bigger, faster, and smarter than you. It's the willingness to accept that your perspective is temporary, that your beliefs must evolve, that your strategies must breathe with the conditions. Humility creates openness, and openness creates survival. The adaptive trader doesn't see being wrong as failure. They see it as feedback. Every loss, every misread, every reversal is information that sharpens awareness. When you stop predicting, you start perceiving. You begin to see the market not as something to conquer, but as something to understand. You stop trying to impose your will and start aligning with its rhythm. That's when trading stops being emotional and becomes mechanical. You don't hope anymore. You observe. You don't react. You respond. The adaptive mind knows that the market is neutral. It doesn't punish or reward. It simply moves. What you interpret as punishment is usually just resistance to change. One of the greatest emotional traps in trading is attachment to outcomes. When you predict, you build a story and expectation, a belief about what should happen. And when reality diverges from that story, pain follows. The market doesn't cause that pain. Your attachment does. Adaptation removes the need for attachment. You can accept loss without emotion because it's not a violation of your identity. It's just part of the process. You win, you adjust. You lose, you adjust. Either way, you evolve. The professionals don't survive because they're right more often. They survive because they manage being wrong better. They don't bet on predictions. They bet on probabilities. They know every outcome is uncertain. So they design systems that work across multiple scenarios. They focus on position sizing, stop placement, and execution quality. They adapt their exposure to volatility, not to opinion. Their mindset is flexible, their rules are structured, and their ego is silent. That's why they last. To adapt effectively, you must master psychological flexibility. It means you can shift from belief to observation instantly. It means you can update your thesis without self-judgment. It means you can face contradiction without denial. Most traders can't do this because they confuse consistency with rigidity. They think sticking to your plan means never changing it. But true consistency isn't about doing the same thing. It's about thinking in the same disciplined way, regardless of changing conditions. The illusion of prediction gives you short-term comfort but long-term pain. Adaptation feels uncomfortable in the moment, but creates long-term mastery. When you predict, you become emotionally invested in being right. When you adapt, you become emotionally free. That freedom is what allows you to think clearly when everyone else panics. In a crash, the predictors lose control. The adapters quietly position themselves. When prices recover, the crowd calls them lucky, but luck has nothing to do with it. Adaptation looks like luck, only to those who don't understand preparation. Adaptation also requires self-awareness. You can't adapt externally if you're rigid internally. Most people don't fail because of lack of strategy. They fail because of psychological inertia. They can't let go of old patterns. They resist updating beliefs that no longer serve them. They keep fighting the last market environment long after it's gone. The adaptive trader knows that every cycle demands a new version of themselves. They evolve mentally before the market forces them to. In the crash of 2026, those who survive won't be the ones who predicted it. They'll be the ones who adapted to it. The predictors will say, "I knew it would happen," but knowing doesn't make money. Adjusting does. Adapting means you've built a process that functions in chaos. You've accepted that volatility is opportunity. You've learned that your job isn't to forecast, it's to navigate. The market doesn't care what you think will happen. It only rewards what you do when it does happen. Adaptation is emotional agility. It's the ability to stay fluid when your beliefs are challenged. It's the capacity to update your view when new information arrives without shame, frustration, or ego. Most people resist this because changing your mind feels like weakness. But in markets, it's strength. Every great trader has learned to say the most profitable phrase in finance: "I was wrong." That phrase isn't defeat, it's evolution. It's the moment ego dies and awareness expands. The act of adapting begins with observation. You can't change what you refuse to see. Watch your own reactions during volatility. Do you freeze? Do you double down on denial? Do you look for confirmation of your bias? Those reactions are data. They reveal where you're emotionally rigid. Adaptation starts by acknowledging that rigidity. The more honest you are about your patterns, the faster you evolve past them. The market is a mirror. It reflects your level of adaptability back to you. If you're flexible, it rewards you with survival. If you're rigid, it punishes you with elimination. Every losing streak, every blown account, every emotional meltdown is a test of flexibility. Can you accept that what used to work no longer works? Can you shift your approach without losing your identity? Can you let go of certainty and trade probability instead? Adaptation doesn't mean abandoning structure. It means refining it. It means your process evolves with your awareness. You might change your time frame, adjust your risk, or shift your focus. You might trade less, observe more. Adaptation is dynamic stability. It's balance in motion. Like a surfer adjusting to the wave, you stay balanced not by staying still, but by moving intelligently. The market will always change. Your job is to stay synchronized, not static. The greatest danger in prediction is that it blinds you to possibility. When you decide what must happen, you stop seeing what is happening. Adaptation requires curiosity. It requires you to ask, what's the market showing me now? Instead of what do I want it to do? That question keeps you aligned with reality. It keeps you open. It prevents you from becoming the kind of trader who keeps fighting yesterday's battle while today's opportunity passes by. In every crash, every rally, every sideways grind, adaptation is what keeps you alive. When the rules of the game change, you rewrite your playbook. You don't complain about volatility. You adjust your exposure. You don't argue with price. You follow it. You don't panic when systems fail. You innovate new ones. That's the mindset that thrives when others collapse. The adaptive trader doesn't seek comfort. They seek alignment. They don't need to know the future. They just need to stay fluid in the present. Every major turning point in financial history was missed by those who tried to predict it and captured by those who prepared to adapt. The Great Depression, the dot-com bust, the housing collapse, the pandemic panic, all had clear emotional markers. Fear peaked, structure broke, belief systems collapsed. The survivors weren't prophets, they were adapters. They saw the emotional extremes and used them as signals to shift behavior. They didn't know when it would end, but they knew how to adjust when it did. So stop chasing predictions. Stop demanding certainty. Stop worshiping forecasts that give you the illusion of control. The market doesn't reward profits. It rewards professionals. Professionals don't predict, they position. They don't need to know what's next because they know how to respond to whatever comes next. Adaptation is not just a strategy, it's an identity. It's who you become when you stop resisting change. It's the mindset of humility, awareness, and readiness. When you master adaptation, you realize that survival is not luck. It's discipline practiced through uncertainty. Every adjustment, every pivot, every course correction compounds into resilience, and resilience is the ultimate edge. In the end, survival in the market is not about guessing the future, it's about staying present enough to respond to it. The ones who predict will always talk about what they knew. The ones who adapt will quietly build wealth from what they understood. Because in trading, as in life, it's not the one who predicts the storm who prospers. It's the one who learns to sail through it. Adaptation is the ultimate trading edge because it transforms uncertainty into opportunity. The market doesn't reward those who claim to know. It rewards those who can adjust without hesitation. When you stop trying to predict and start responding, you move from fear to flow, from ego to awareness. Every crash, every rally, every reversal becomes just another wave to ride. The survivors of the 2026 market won't be the fortune tellers. They'll be the adapters. In chaos, they don't ask why, they ask how. And that question keeps them alive, profitable, and free.